Usually, when we think about buying a house, we picture roots.
Right, yeah, permanence.
Exactly. You picture permanence. You're buying a literal piece of the earth. You
Yeah.
get a traditional mortgage, and that loan is, it's quite literally anchored to the ground beneath your feet.
Right, because you break ground, you pour a concrete foundation.
And suddenly the property is legally, physically, and financially immovable. The land and the structure are just bound together.
Which is, I mean, it's a very binary way of looking at the world, but it is the foundation of traditional finance.
Right.
The land and the building form this one undeniable entity in the eyes of the law and, more importantly, in the eyes of the bank.
Banks love permanence.
Oh, absolutely. A fixed asset is a comforting asset, cannot vanish in the middle of the night.
But then you step into a totally different reality.
Wow.
Like, what happens when the thing you are buying, whether that's the place you're going to sleep in every night with your family, or like the massive piece of heavy machinery you absolutely need to run your business, isn't attached to the earth at all?
Right, it's just sitting there.
Yeah. What if your house can literally be hoisted onto a flatbed truck and driven across the state?
Or what if your business asset flies across international borders at 30,000 feet?
Exactly. Suddenly, that traditional financial rulebook, the one built on roots and permanence,
Yep.
just goes completely out the window?
It forces a completely different paradigm, really, for ownership and for collateral.
Yeah.
The entire mechanism of how money is lent has to change when the asset can just, move.
Which brings us to our mission for today. We have a really comprehensive financial guide sitting in front of us covering a concept known as chattel mortgages.
Yes.
Okay, let's unpack this. Our goal for today's deep dive is to figure out exactly how you finance a life or, a massive business that isn't bolted to the earth.
It's a fascinating topic.
It really is. So we're going to take the source material, which, fair warning, is pretty heavy on definitions, loan types, and regulatory frameworks.
Very heavy on the jargon.
Yeah, lots of jargon. But we're going to translate that into the actual mechanics of how this works. By the end of this deep dive, you are going to understand a financial gear that powers a staggering percentage of American homeownership and industrial infrastructure.
Yet it operates almost entirely out of the public eye.
Exactly. So to crack open how these specific loans work, we first have to recognize a fundamental distinction, right?
Right. How the financial and legal systems categorize the physical world.
Yeah.
We have to draw a hard line between the stuff you can move and the stuff you absolutely cannot move.
Let's start with the name itself, which honestly sounds a bit archaic. A chattel mortgage.
It does sound.
The sources gave us quite the list of wild synonyms for this, actually. I was reading through the text, and apparently, depending on the context, you might hear this called a security agreement? Or
personal property security?
Right, or a lien on personal property.
Yeah.
But my absolute favorite, and I think the most aggressively complex one by far, is movable hypothecation.
Movable hypothecation. It sounds like a complex legal maneuver from the 19th century or something.
It really does.
But if we break down the terminology, it's incredibly literal. Chattel simply refers to personal property that isn't real estate.
Okay.
It's just anything tangible you can move. And that intimidating phrase, movable hypothecation.
Yeah, what does that even mean?
Well, hypothecation just means pledging an asset as collateral for a loan while you, the borrower, get to keep possession of it.
Oh, I see.
Yeah, so add the word movable, and you have the core concept. You're pledging a movable asset to the bank while you continue to use it.
So mechanically speaking, this is essentially the exact same framework as a standard auto loan.
Precisely.
Like, if I finance a car, the bank holds the title, but I get to drive it to work every day.
Yep, you still have the keys.
Right, so I'm not mind blown by the concept of conditional ownership itself. But what is striking to me here is the application of that auto loan mechanic to human housing and massive industrial infrastructure.
That's where it gets wild.
Because with a traditional mortgage, I buy a house on a plot of land. I am the legal owner.
Right. The deed is in your name.
Exactly. The bank just holds a lien, a claim to the property if I stop paying, but I am still the owner.
Right.
Are you saying that when a family buys a home using a chattel mortgage, that dynamic is fundamentally flipped? Like, is it essentially a glorified rent-to-own situation until the very last payment?
What's fascinating here is how that conditional ownership changes the power dynamic of the entire arrangement.
Yeah.
Yes, with a chattel mortgage, the lender actually holds an ownership interest in the property until the borrower fully pays off the loan.
Wow.
The lender technically owns the manufactured home, or, the bulldozer, while you are making your monthly payments.
That's crazy.
Ownership only transfers to the buyer at the very end of the mortgage term, assuming every single payment has been made in full.
Which radically changes the stakes if the borrower misses a payment.
Oh, entirely.
Because with a regular piece of real estate, if you default, there is an incredibly long, drawn-out foreclosure process.
Yeah, you have capates.
Mandatory waiting periods, legal notices. I mean, it can take months, sometimes years, for a bank to actually take back a house.
Because taking real property is deliberately difficult by design.
Right.
But if you default on a chattel mortgage, the mechanism for the lender to recover their loss is entirely different. They don't have to foreclose on a piece of land.
Because they already own it.
Exactly. The creditor can simply take possession of the financed property. Because they already hold that ownership interest, and because the item is physically movable, they just come and get the asset.
Just drive it away.
They repossess it and sell it to pay off the balance of the loan.
So if the recovery process is that swift and the conditional ownership is that strict, what are we actually talking about financing here? I'm just trying to picture the person who actually signs this contract. If I know the bank can just drive away with my house if I miss a payment, why would I ever agree to that over a traditional loan?
Well, often it's not a choice, but a structural necessity.
Okay.
You might be surprised by how massive the footprint of this lending is in the housing market alone.
Really?
Yeah. According to the Consumer Financial Protection Bureau data in our sources, a massive 42% of the loans used to purchase manufactured homes are chattel loans.
Wait, 42%?
Almost half.
Almost half of all manufactured home loans. That is a staggering number of people living under a financial arrangement where they don't legally own their home until the final payment.
It is a massive segment of the population. And the reason for this comes back to that hard line between movable and immovable property we talked about earlier.
Right.
This happens primarily when people buy a mobile or manufactured residential unit, but they lease the land that the unit sits on.
Ah, I see.
Imagine moving into a manufactured home community. You're renting the concrete pad, the driveway, and the small yard, but you are outright buying the actual house that gets delivered to that pad.
Which creates a geographic and financial puzzle.
Exactly.
Because they don't own the dirt underneath the home, a traditional real estate mortgage is mathematically and legally impossible.
Yeah, a bank cannot anchor a 30-year traditional loan to a piece of ground the borrower is just renting month to month.
The home just cannot be legally classified as real estate.
Right. It must be classified as personal movable property.
It's essentially like a turtle carrying its shell.
I like that analogy.
Yeah, you own the shell, you sleep in the shell, you maintain the shell, but you don't own the ground you're walking on.
Right.
And what really highlights the bizarre nature of this is that the financing arrangement stays in full effect even if you physically pack up that shell.
Oh, absolutely.
The source points out that you can literally load that mobile home onto a transport truck, move it to a completely different location, and the loan doesn't change.
Because the geography is entirely decoupled from the asset. The loan is on the turtle shell, not the ground.
Wow.
If you hitch your house to a truck and move it 3 states over, the chattel mortgage simply travels with you. The lender's ownership interest remains perfectly intact, regardless of the GPS coordinates.
So we've established that a house can move across state lines and keep its mortgage. But what happens when the asset doesn't just cross state lines, but crosses international borders?
That brings us to the commercial side of our source material.
Right, because companies use these exact same loans for heavy equipment and high-value transport.
Yes.
We're talking about construction gear, farming combines, tractors, and it scales all the way up to commercial fleet vehicles, massive boats, and even airplanes.
This is where you see chattel mortgages serving as the underlying engine for massive segments of the global economy.
Yeah.
Consider a scenario where a mid-sized construction firm needs to acquire, say, 20 heavy excavators for a multi-year infrastructure project.
That's a huge expense.
Right? They cannot possibly liquidate enough cash to buy 20 excavators outright. So they utilize chattel mortgages.
Okay.
This arrangement allows the firm to physically take possession of the equipment, put it to work immediately, and generate the revenue needed to pay off the loan, all while the lender retains the underlying ownership interest.
But the friction there seems incredibly high when it comes to tracking.
It can be.
Because with a house, even a movable one, it generally stays put for a few years. But with something like an airplane or a fleet of construction vehicles moving between job sites, keeping track of who really owns what could get chaotic,
It would be a nightmare.
Yeah, and the source material mentions some hyper-specific rules and registries depending on what you're buying and where you are.
Well, the registries are non-negotiable because the financial system relies entirely on certainty.
Right.
If an asset is highly valuable and easily movable, the risk of fraud or even just administrative confusion skyrockets.
Yeah.
Let's say an airline wants to buy a $50 million airplane and they put it up as collateral for a chattel mortgage. How does a secondary lender or a buyer 5 years down the line know that the original bank still has a claim on it?
Right, because a Boeing 737 can be in New York on Tuesday, London on Wednesday, and Tokyo on Thursday.
Exactly.
I could just fly the plane to another jurisdiction and try to secure a second loan against it.
To prevent exactly that kind of international shell game, the system relies on centralized, undeniable public records.
Okay.
For aircraft specifically, the sources note you have to record that security agreement with the Aircraft Registration Branch of the Federal Aviation Administration.
Oh, the FAA.
Yeah, the FAA needs to know exactly who holds the strings on every single plane in the sky. It creates a clear chain of title.
And the sources note this happens on a localized level too, right? Like in Florida, chattel home loans have to be listed in a public registry.
Yes.
Which makes sense given the high density of manufactured home communities in Florida.
It does.
It serves as a formal, legally binding warning to any third parties. Hey, just so everyone is clear, the bank still owns this specific mobile home. Do not lend against it.
It eliminates the ambiguity.
Yeah.
The lender needs absolute certainty that their collateral is truly their collateral, no matter where it's parked or where it lands.
Okay, here's where it gets really interesting to me, though. I want to push back on the economic logic of this entire arrangement. Let's look at the actual strings attached to these loans from the borrower's perspective.
Sure.
We've established that the lender gets to keep the ownership interest.
Right.
And we've established that if a borrower defaults, the lender can just easily repossess the bulldozer or the mobile home without going through a year-long, expensive real estate foreclosure in the courts.
Yes, very fast.
So if the recovery is that much easier, the risk profile for the lender seems significantly lower. If these loans are safer and easier for the bank to resolve, shouldn't they be much cheaper for the borrower?
It is a completely logical deduction. You would naturally assume that a swift, frictionless repossession process equals lower risk, which should theoretically translate to lower interest rates for the consumer.
Yeah.
But the reality outlined in the data is the exact opposite. Chattel mortgages generally carry significantly higher interest rates than regular real estate mortgages.
Which feels entirely counterintuitive until you dig into the mechanics of the collateral itself.
Exactly. The difference lies in the nature of movable property versus real estate.
Okay.
Think about a traditional mortgage. Historically, and generally speaking, land appreciates in value over time.
Right, land goes up.
A traditional mortgage is secured by an asset that is likely becoming more valuable. The bank's collateral is growing.
Well, movable property is essentially doing the opposite.
Almost universally,
Mhm.
movable property depreciates.
Right.
An excavator begins losing value the exact second you fire up the engine on a job site. An airplane ages and requires massive maintenance.
Yeah.
Even manufactured homes, specifically when they are decoupled from the land beneath them, depreciate in a way that is much closer to a vehicle than a traditional house.
So you're saying the lender's risk isn't about the difficulty of recovery, it's about the decay of the asset itself.
Precisely.
The bank is essentially in a race against the bulldozer's engine failing. Sure, they can repossess it easily, but what they are tossing onto the back of their flatbed truck is worth drastically less than the day they financed it.
That's it. They're charging a higher interest rate up front to explicitly price in the constant decay of the collateral. It's a mathematical hedge against depreciation.
Which also explains the timeline of these loans, right?
Yes.
The sources explicitly state that chattel mortgages typically feature much shorter loan terms than the standard 30-year real estate mortgage.
The lender needs the borrower to pay off the principal before the asset depreciates to a point where it's worth less than the outstanding loan balance.
That makes sense.
They cannot stretch a loan for a tractor over 30 years because the tractor will be scrap metal by year 15.
But if we apply that math to the 42% of people buying manufactured homes, the reality is brutal.
It really is.
If you're taking on a higher interest rate and you compress the entire repayment schedule into a much shorter window of time, say 15 years instead of 30,
Right.
your required monthly payment is going to be significantly higher relative to the total amount you borrowed.
And you combine that financial squeeze with the fact that the text notes there are generally fewer consumer protection.
Oh, right.
Because these are legally classified as personal property loans rather than traditional real estate mortgages, borrowers often lack the same regulatory safety nets.
That's scary.
They might not have access to extended grace periods or the mandatory mitigation and counseling processes that are legally required before a traditional home foreclosure can proceed.
So we have a scenario where a massive segment of the population is utilizing these loans for their basic fundamental housing, but they're navigating higher interest rates, aggressively compressed repayment terms, and fewer legal shields.
Yeah.
Left completely to the free market, that sounds like a formula for a localized housing crisis.
It presents a significant systemic vulnerability. The free market alone would likely price many people entirely out of these loans due to the depreciation risk.
Right.
But this is exactly where the federal government steps in to alter the equation. The sources detail a framework of government programs deliberately designed to stabilize this market.
Providing a bit of a silver lining that makes these loans accessible.
Exactly.
Because the government has a vested macroeconomic interest in keeping construction fleets running and keeping citizens housed, regardless of whether they own the dirt under their feet.
Right.
The government doesn't directly hand you the money, but they step in to guarantee the loans through approved private lenders.
We see a multi-agency approach to this. The Department of Housing and Urban Development, HUD, is deeply involved.
Okay.
The Department of Veterans Affairs, the VA, has programs. And the USDA's Rural Housing Service plays a major role.
Wow, so all over the place.
Yeah, they all offer guarantee programs for manufactured home loans. And on the commercial side, the U.S. Small Business Administration provides crucial guarantees for equipment financing.
Like the SBA 504 loans.
Yes, exactly, which help businesses secure long-term machinery.
I want to look at the specific math the government utilizes to bridge this gap, specifically on the housing side.
Sure.
The sources provided some really concrete numbers regarding down payments. While down payments depend heavily on the specific lender and your credit profile, the FHA's Title I loan program, which is HUD's specific vehicle for manufactured homes without land, offers incredibly accessible terms.
The Title I program is engineered specifically to lower the barrier to entry by shifting the risk.
According to the text, if your credit score is above 500, you are only required to make a 5% down payment.
That's very low.
Yeah. Now, in the financial world, a 500 credit score is not considered high by any conventional metric.
No, it's not.
And even if your score dips below 500, the requirement only bumps up to a 10% down payment. That fundamentally changes the math for a family trying to secure shelter.
It's a powerful mechanism for expanding liquidity in the housing market.
Yeah.
By stepping in and guaranteeing a portion of the loan, the FHA absorbs a significant amount of the depreciation risk that the private lender is terrified of.
That makes total sense.
That federal guarantee is what unlocks the private lender's willingness to offer a 5% down payment on an asset they know is going to lose value.
There is another major silver lining, the source pointed out, which activates at tax time.
Oh, the tax perks.
Yeah. If you are living in a manufactured home under a chattel mortgage, paying those higher interest rates, you still want to know if you can utilize the same tax breaks as the person living in the traditional brick-and-mortar house down the street.
And the tax code largely accommodates that. The interest paid on a chattel mortgage used for a primary residence may be tax deductible.
It's just like a regular mortgage.
Functioning exactly like the mortgage interest deduction on a conventional home loan.
Which is a critical piece of financial relief. If your interest rate is inherently higher due to the nature of the loan, being able to deduct that interest against your income softens the blow considerably.
Additionally, the source points out a pathway to further parity. If a borrower has a manufactured or modular home that is eventually affixed permanently to a foundation on land they own.
They anchor it.
Right. They may be able to transition the classification and take advantage of traditional property tax deductions as well.
So what does this all mean? Let's bring all these mechanical pieces together.
Okay.
We started by looking at the traditional concept of real estate loans that are quite literally anchored to the earth.
Right.
But today, we've cracked open the alternative reality of the chattel mortgage. It's the vital financial engine that unlocks ownership for the movable world.
It really is.
From the fleets of excavators building our infrastructure to the commercial airlines crossing our skies, to the 42% of manufactured homes providing shelter across the country.
It's an entirely indispensable financial tool.
But it operates on a completely different set of rules.
Ah,
You gain the ultimate flexibility of decoupling your shelter from the land beneath you, or you gain the immediate operational use of multi-million-dollar business equipment.
right.
But that flexibility comes at a steep price. You're trading away traditional consumer foreclosure protections.
Yep.
You're paying higher interest rates to offset the relentless depreciation of the asset. And you're operating in a strict legal reality where the lender retains actual ownership until you make that final payment.
Exactly.
It's a high-stakes, fast-moving financial arrangement that only functions because it's stabilized by federal government guarantees and tracked by rigid public registries.
If we connect this to the bigger picture, what stands out is how this reflects the sheer adaptability of our financial infrastructure.
Yeah, that's a good point.
A chattel mortgage proves that the market doesn't simply freeze when an asset isn't poured into a concrete foundation.
Right.
It develops complex, nuanced, and highly regulated ways to price risk and secure collateral, seamlessly adapting whether those assets are sitting in a mobile home park in Florida or flying at 30,000 feet over the Atlantic.
It constantly finds a way to keep the gears turning, adjusting the math to fit the physical reality of the asset.
Absolutely.
And that brings me back to the image we started with, that traditional idea of roots, of the home permanently anchored to a single plot of ground. I want to leave you with a final thought to ponder as you look at the evolving world around you.
Because the landscape of how we live and work is undeniably shifting.
Exactly. As modern life becomes increasingly mobile, we're watching the massive, sustained rise of remote work, the cultural explosion of the tiny house movement, and an entire generation embracing digital nomadism.
It's changing everything.
You have to wonder, will that traditional immobile white picket fence mortgage eventually become the exception rather than the rule?
That's a fascinating question.
As more people actively choose to decouple their lives from a specific piece of geography, carrying their homes with them like that turtle with its shell, could the flexible, movable nature of the chattel mortgage actually become the dominant blueprint for the future of property?
It makes you wonder what the very phrase real estate will even mean 50 years from now.
It forces us to question whether the future of ownership is based on permanence or mobility.
Oh, sure does.
The next time you see a wide-load home rolling down the interstate on a flatbed or a massive tractor working a field, you now know the exact financial mechanisms powering it behind the scenes. Thanks for diving deep with us today.